Good afternoon, everybody. At the outset, Dr. Mishra and the IIBF team, thank you very much for inviting me here. It's a pleasure to be here. I'll take a few minutes of your time to conduct a thought experiment. Right? So everybody understands what is asset quality, right? You're all bankers in this room. Everybody understands asset quality? Yeah? Show of hands? Asset quality. Okay. So I'll take an example of two banks, N Bank and S Bank. Okay. So these two banks are both giving loans of, let's say, 1 crore. And they've got 100 borrowers. Everybody gets 1 lakh each. Okay. And in the case of S Bank, 3 of the borrowers did not give back the money. In the case of N Bank, 2 of the borrowers did not give back the money. Or maybe let's say one borrower did not give back the money. So which is the better asset quality? They're all loans of 1 lakh each, 100 borrowers, 1 crore in N Bank, 1 crore in S Bank. So N Bank, 1 borrower did not give back the money. S Bank, 3 borrowers did not give back the money. Which is the better asset quality? Anybody? Which is the better asset quality? Sorry? Surely, the 3 guys who didn't pay back, that's a poor asset quality, right? One guy didn't pay back, you lost only 100,000 rupees. Let's further extend the argument. Let's say that N Bank charges 11% on its loans and S Bank charges 15% on its loans. Is the answer still the same about which is the better asset quality? So let's say that I made, right, 1.5 lakhs extra because I charged more interest, so I can absorb a higher loss rate. So at a very fundamental level, what analytics can do is change the lens through which you perceive your business. You can effect a paradigm shift as to how your business is evaluated. Asset quality is not about loss rates. Banks are in the business of buying and selling goods, and in our case, that good happens to be money. And our profit margins are what we are going to be evaluated by at the end of the day. Don't worry about what you read in the headlines about NPAs and gentlemen who fly away to London in the middle of the night. If you are making money, you're getting it right. While we were taking the break, we were just discussing the case of microfinance. Right? Microfinance, they have loss rates of under 30 basis points, typically. Decent microfinance here. I'm not even saying the best of class. A decent microfinance operation runs at around 30 basis points or less in loss rates. And they also charge 25-26%, they're capped at 26%. So they charge a high interest rate. So they make a lot of money, but they also have a very high cost of funds because they're not a bank. Banks typically have lower cost of funds. So what's happening is that these organizations, you are generating, let's say, 1,000 rupees in interest revenue, out of which you got a significant part which is cost of funds. Let's say 60 or 70 rupees is cost of funds. The remaining 30 rupees has to provide for your profits, has to provide for your operating costs, and has to provide for your credit costs. Right? So if you are able to manage either of the two, so instead of generating 100 rupees of revenue, you can generate 110 rupees of revenue from the same book, or if you are able to reduce your operating costs or your credit costs. Any of these 3 levers, or even your cost of funds, any of these 4 levers is acceptable, is viable for meeting your end objective, which is profitability. Right? So analytics has the ability to address and attack each of the levers which drives profitability in the bank. And that's what we are doing. So there are, Mr. Ghose has spoken at length about various kinds of analytics initiatives that we have undertaken at State Bank. I think we are doing a terrific job because we have at our disposal the largest banking database in the world. We are not just metaphorically a banker to every Indian, we are the banker to every Indian. We have that information and we have a lot of information about our clients. We're able to do pre-approved lending, etc. There are 2 aspects of managing asset quality through analytics. One is preventive and the other is curative, and we address both ends of the spectrum. So preventive is when before you make the loan, you try and assess how good is the repayment ability of this individual, and you take a decision of whether to give the loan or not to give the loan, or at what rate to give the loan, right? So you're also baking in risk-based pricing on the loans. On the curative side, you're looking at the collections and how do you fine-tune your collection strategy. How do I make sure which is the customer I go after? So some simple things that you can do when both Jaspal and Rajat were talking about geospatial, right? So very often what used to happen is that a customer who has only 20,000 rupees left to pay and he's not paying, it's not worth my time to go and chase him. But if I can do some geospatial clustering, I know that there are 6 people who live in the same building who each owe me 20,000 rupees, then suddenly it becomes more worthwhile to make one trip to that building than go to one other location where somebody is going to pay me 50,000. So lots of things that you can do both on the preventive side and the curative side. I'm not going to elaborate on each of them. I'm happy to address questions on that later. The other thing I think that analytics can do, and we do, is you address things at a policy level. So while your preventive and curative measures are going to be at an individual borrower level, when you start applying analytics at a policy level, you have a very broad brush through which you can affect changes. To take a very simple example, again continuing with the N bank and S bank, for those who have probably guessed it, S bank is the smart bank and N bank is the not so smart bank. So to take the same example of the N bank, S bank, at a policy level, I can have a cap and threshold mechanism in place. So I say that there's a higher threshold to be met for high quality loans, for people who will get a discounted loan. But there my cap is going to be higher. So I'm willing to give a lot of loans at a high quality. But I can set a low cap and a low threshold for my subprime or near prime lending based book. So there I say that I'm willing to give loans in the CIBIL parlance, for example, to somebody who's got a 650 CIBIL score. But I'm going to cap that at no more than 10 crores a month. Whereas my customers with a 750 score, I'm willing to give up to 100 crores. So you have, at a policy level, you can take those decisions about cap and threshold, so you can manage the asset quality and the business mix of the loans. So we are doing a fair amount of work at SBI in those terms. We're trying to figure out which are the loans which are more profitable as defined as the profit that they earn and not just in terms of the loss rates. So that's the kind of work we are doing. There's a huge amount of work to be done. We have a large portfolio and there's a long journey. Fortunately, we have got excellent leadership and we've got excellent team. So it's my privilege and my joy to have been doing this. That's all I have for now. I'll take questions later. Thank you.
Thanks to IBF and Dr. Mishra for this opportunity. Deep provided me the perfect transition for my quick talk on the human aspects of analytics and adoption of analytics and how that is equally important to generating the right insights. So I would start by sharing that, the foundation of economics and human behavior till now traditionally has been laid on the premise that human beings act rationally. That presented the same set of information, we would behave in the same fashion and react in the same way. But research shows that that's not how human beings behave. Human beings are not rational. Human beings are, influenced by biases. Human beings are also influenced by the way the information is presented. The same charts you can present in 2 different ways and they'll have 2 different impressions. You just change the scale and people will react differently to it. So just as an example, this was an actual research done by a car company that you present to customers, choices of the features that they want in a car. So in one, you give, a model with a particular price with say 10 features included and the option to remove each feature one by one and come down on the price or add 2 more features and go up. In the other, you just give a completely base model without any of these additional features and the option to add each feature. Conventional wisdom would say that people, would not make a different decision in these 2 situations given this set of information because they would know what features they want, what they don't want, what's the price of each feature and whether, it makes a sense or not. But that's not how, the research panned out. What research showed is that depending upon what information you showed, people reacted differently. Just to satisfy your inquisitiveness, the people who were presented the option of having the car with a standard price with 10 features actually chose many more features or all of the features as compared to people who were given a base option. And that is because of the biases in the mind and a perception that a pre-selection has been done, which is which is optimized for the customer requirements, etc. So that is basically the reason why we also have to think about the human aspects of adoption of analytics, because that's been a challenge for most organizations. You can have the most powerful systems, but they won't be of help unless the organization actually adopts analytics. In order to get to adoption, of course, as the speakers today talked about, you first need the data to be brought together, whether it is just in-house data, limited data, or it's big data. Then you need the analytical systems and architecture to be able to process that information. And then finally, you need to be able to, as Mr. Gupta was talking about, be able to blend that information into your business processes. Either you can automate it, or if you cannot automate it fully, then your people have to be in a position to, respect and use that information in their decision making. KPMG has done some research, and what we find is that banks in India have typically been investing in analytics for just about the last 3 years or so. And of course, the multinational banks have been doing that and very successfully, like Vijay and Citibank and all. They've been doing it for a long time. American Express has been at the forefront, but the Indian banks, with the exception of ICICI, etc., possibly have started in the last 3 years. And hence it's important for them to look at how they're still new in the journey. Adoption is not fully there across the organization. And if you have to make analytics the differentiator and the core competence, you really need to look at adoption of analytics. What we have found at KPMG in our research is that some of the important things that drive adoption of analytics in an organization is, first, is a very important top-down mandate. So if you look at organizations where there was a top-down mandate and enforcement of that mandate, how does enforcement of the mandate happen? Of course, you tell people that they have to, take decisions based on analytics, but the management needs to start asking questions. Whenever somebody comes with a recommendation, etc., they should say, okay, what is the underlying data? What are the underlying facts because of which this is a recommended decision or this is the recommended action that we have to take? So that's how you enforce it, and you have scorecards, etc., and analytics assessment to say, okay, how much adoption of analytics is there in your actual decision making. So the organizations that have been successful in adopting analytics, more than 90% of them had a strong top-down mandate, and the executives in those organizations believe that this is the most important component of adoption of analytics. You can have analytics bubble up from the bottom, but that's in less than 10% of the cases that it has really been successful in terms of adoption. The other question that I'm asked by most organizations is, what is the right organization structure or operating model for analytics in an organization? Should we have centralized analytics? Should we have decentralized analytics sitting within the business units? Should we have a federated structure, where there is some combination of centralized and decentralized analytics? Our research shows that organization structure actually has no bearing on success or adoption of analytics. That is not really important. You could start anywhere and go on. However, the path that most organizations seem to take is they start with centralized analytics because it's easier to manage and scale. Again, it is not necessarily that it will automatically lead to adoption, but it is easier to manage, it is easier to scale and control, and then it spreads out into all parts of the organization and then ends up with a federated structure. That's how typically for evolved organizations globally the journey of analytics has been. So if you are looking at starting an analytics organization, you may want to consider these models, and if you want to follow the path that most successful organizations have taken, that's how they seem to have evolved. Same is true for digital. You need to start with a centralized organization because today very few people understand digital, and if you spread it out, the skills are so less that you can't, and you really can't service the needs of the whole organization, and the effort will be completely disorganized. But eventually, as you go down the multi-channel path and analytics, eventually it has to become a way of life for every person in the organization. And that will happen, after people have built the trust in analytics. They are comfortable with what analytics is telling them, and they understand it. As I said, the model cannot be esoteric. The model has to be, you have to be able to explain analytics. You have to be able to translate that business, the analytical insight into a business insight, and be able to explain the models to the business to ensure that they really use those models. If they don't understand it, they will not use it. The other important aspect of adoption of analytics is, there have to be some people in business who, understand a little bit of analytics, and there have to be analytics professionals who understand enough of business. And when you have these kinds of people in the organization, that's when business problems get translated into analytical problems, and analytical insights get translated into business insights. So this is the breed of people, very important on the business side, and there are very few of them. It's not easy to find. They understand business very well, but they understand enough analytics to be dangerous. So these people are what I would call the evangelists of analytics in the organization, and they are the first adopters. And when they adopt it, and when they explain it to their peers and colleagues and their department, then the adoption of analytics starts farther. The other starting point is not to take the resistance to analytics head on. What is perhaps more beneficial is to augment the decision making with analytics. So first, provide the insights to people. Don't replace the decision making, because today technologies exist where you can go straight to automated decision making. But that's not the best way to do it, because you may not have the certainty of the fact that you have understood all the parameters in the model that need to be considered. There could be hidden aspects that a human being can bring out. The second thing is that it will create further resistance to advancement of analytics if they see that as this is completely replacing human judgment, and it can't, at least for the foreseeable future. So augment the decision-making capabilities by making the data available, by making the insights available, and let the human being still make the decision. You can, get him to automated decision-making by questioning him over a period of 3, 4, 6 months to say, why is his decision deviant from what the system is suggesting? You can do that, and you will find that typically analytics will beat human judgment because it is consistent, and the analytics models will continue to grow, because once a human being challenges that model, you can take the insights and build it into the model to further improve its performance and efficiency. But over a period of time, you will find the model beating the human beings, or at least a majority of the human beings, because 100 people in the organization are not equally capable of taking that decision. And maybe there are 2 or 3 people who will beat the analytics, but a large majority of people will not beat analytics. Oops. I'm sorry, didn't realize 10 minutes go that fast. Can I take a few more minutes? Please, thank you. The other few challenges that you will face while adoption of analytics are that it is easy to hire skills, but very difficult to retain skills. And also, you need a different career path for analytics people in your organization. The traditional career path won't work for them. They are also motivated by different requirements. I mean, the people here are an exception. Most typical analytics people are not very comfortable being extroverts and coming out and talking on stages, etc. So, and they are motivated by different things. And you have to, make sure that you're creating the space for them in the organization, and the performance management processes are also equally calibrated and tailored to be able to grow that breed of people in your organization. One more point I would like to touch on is trust in analytics. Trust is very important. You are the custodians of the data of your customers, and you can use it for the enrichment of your enterprise, your bank, or you can use it for enriching your customer's experience and for benefiting him in both, right? Now, the customer will continue to provide you data. Going forward, data privacy laws are going to become even stricter. Ability to use customers' data, there are going to be more and more regulations around that. So if you have to use that data, the customer needs to be convinced and actually genuinely needs to be benefited by the use of that data. And you have to make sure that you're guarding the security, you're constantly looking at the secrecy aspects and keeping the information confidential. You can always use the information that you have for the customer to push certain products to them, but there are instances where that can be misused also. So for example, there is this concept of cool versus creepy, in terms of how the information is used. And that also has a cultural bearing. You walk into a shop and you've got facial recognition software there, or your, handset signature is picked up by the systems in the shop, and a shopkeeper or, a shop floor assistant who you never met comes and walks in and says, good evening, Mr. Ghosh. Are you likely to be delighted, or are you likely to be freaked out? How did he know me? I mean, I didn't disclose my name. So some people will, freak out. They will feel that this is a violation of their privacy. Some people will feel happy that they're, somebody is recognizing me, and the organization has actually gone the distance to basically put in place systems to be able to, recognize a customer and extend a welcome to him. So, that of course, the answer will vary from customer to customer, and that's where we get to the segment of one. Ultimately, the customer segmentation, big data, and all of that will enable us to recognize each individual customer as unique and tailoring our requirements to their need. Let's not target customers in a fashion where we are exploiting their weaknesses. For example, there were some ethical questions raised in the US about targeting young men right out of college with loans, because people knew that they had the capability to pay. They were always going to miss out on installments, and they would pay penal interest on top of that, etc. Now, again, debatable. It may be fine for some, but that excessive focus on that one segment led to the allegation that people's behavioral weaknesses were being exploited. Rather than sending a reminder, you are actually not sending a reminder to those people because they are credit worthy, but if they default, then you get additional penal interest. So those kind of situations going forward will continue to create a block in the mind of the customer with regards to sharing personal information, with regards to sharing Facebook logins, IDs, and Twitter handles with organizations. And that will be the next challenge for banks to face, in addition to fintech, which is going to totally disrupt banking going forward. So that's all from my side. Thank you very much for your patience. And